Hi, I'm Mark with Best of Us Investors. I've been investing for over 40 years. I'd like to share some of my knowledge with you today. Now, I'm not here to tell you what to do, but to just give you some ideas that may help you become a better investor. Remember, this is not financial advice, it's for education purposes only. If you like the content, please hit the like button and also subscribe. That'll help out the channel. Thanks. Now, let's get going. Whether we're a long term investor or we're trying to swing trade, one of the big questions that we have when entering or exiting a stock is at what price do I enter and exit a stock? Well, there's a few tools that I use from a technical trading point of view to help me decide when to get in or out of a stock. One is the MACD, and one is the RSI. This, along with some simple moving averages on a chart over time, can help us assist us in getting into a trade at the right time or getting out of a trade before it turns into a disaster. Now, it's not a 100% guarantee, but it is a tool that we can use. So let's get into it a little bit and talk about the RSI and the MACD and how it can help us be better investors. One of the main tools that I use when determining whether to buy or sell a stock, maybe in a swing trade or I'm going to do a long term investment, is the moving average convergence divergence, or the MACD. So for a definition of what the MACD actually is, we're going to go to Investopedia. You can see moving average convergence divergence, or the MACD, is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26 period exponential moving average, or the EMA, from the 12 period EMA. The result of that calculation is the MACD line. Now, the other line is a 9-day EMA of the MACD called the signal line that is plotted on top of the MACD line, which can function as a trigger for a buy or a sell signal. Traders may buy the security when the MACD crosses above its signal line and sell or short the security when the MACD crosses below the signal line. Moving average convergence divergence MACD indicators can be interpreted in several ways, but the more common methods are crossovers, divergences, and rapid rises and falls. Now, the MACD is often displayed with a histogram, which graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD's baseline. If the MACD is below the signal line, the histogram will be below the MACD's baseline. Traders use the MACD histogram to identify when bullish or bearish momentum is high. So we'll go down, and you can see here is your histogram. As they go lower, it's bearish, bullish. So let's look at an example of a crossover. So we'll look at the chart below, but when the MACD falls below the signal line, there's a bearish signal that indicates that it may be time to sell. Conversely, when the MACD rises above the signal line, the indicator gives a bullish signal, which suggests that the price of the asset is likely to experience upward momentum. Some traders wait for a confirmed cross above the signal line before entering a position to reduce the chances of being faked out and entering a position too early. Crossovers are more reliable when they conform to the prevailing trend. If the MACD crosses above its signal line following a brief correction within a longer term uptrend, it qualifies as a bullish confirmation. So here's a chart that would show a bullish confirmation. As you can see, the MACD is the blue line, the signal line. So at this point that the MACD crosses the signal line, you would see a bullish confirmation. You also see the stock prices rising. Conversely, if the MACD crosses below its signal line following a brief move higher within a longer-term downtrend, traders would consider that a bearish confirmation. So as we see here, the MACD is crossing back over the signal line, signaling a bearish confirmation. You can see the stock price is also retreating. You can also see down here, you'll see on the histogram that we're showing more of a bearish condition. So the MACD is often used in relationship with the relative strength index, or the RSI. The relative strength indicator, the RSI, aims to signal whether a market is considered to be overbought or oversold in relation to recent price levels. The RSI is an oscillator that calculates average price gains and losses over a given time period. The default time period is 14 periods within values bounded from 0 to 100. The MACD measures the relationship between the two EMAs, while the RSI measures price change in relation to the recent price of highs and lows. These two indicators are often used together to provide analysts a more complete technical picture of the market. So let's get a quick definition of the relative strength index. The relative strength index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. The RSI is displayed as an oscillator, a line graph that moves between two extremes. It can have a reading from 0 to 100. The indicator was originally developed by J. Wells Wilder Jr. and introduced in his seminal 1978 book, New Concepts in Technical Trading. Technical interpretation and use of the RSI that values of 70 or above indicate the security is becoming overbought or overvalued and may be primed for a trend reversal or corrective pullback in price. An RSI reading of 30 or below indicates an oversold or overvalued condition. So in this example, here's your RSI, here's your stock price. You can see as the RSI comes up to the 70 line, it's considered overbought. It'll come back down, overbought, and then down when it hits below 30%, it's considered oversold. This is a momentum indicator that technical traders use. So there are a few more tools that I want to mention that are important when you're looking at charts. And we'll start with the 200-day simple moving average. So the 200-day simple moving average is considered a key indicator by traders and market analysts for determining the overall long-term market trends. The indicator appears as a line on a chart and meanders higher and lower along with the long-term price moves in the stock, commodity, or whatever instrument that is being charted. The 200-day SMA seems at times to serve as an uncanny support level when the price is above the moving average or a resistance level when the price is below the moving average. The 200-day moving average is represented as a line, again, on the chart, and it's an average price over the past 200 days or 40 weeks. The moving average can give us as traders a sense regarding whether the trend is up or down, while also identifying potential support or resistance, as we just talked about. The 200-day and the 50-day moving averages are sometimes used together, with crossovers between the two lines considered technically significant. So the crossovers indicate either a golden cross when the 50 crosses above the 200, or a death cross when the 50 crosses below the 200. While the simple moving averages is the average price over time, the exponential moving average gives greater weight to the most recent data. So here's basically a death cross. So you can see here's the 50-day moving average. And as it crosses the 200, they call it a death cross because you can see what happens to the price normally after a death cross. So here's an example of a golden cross. You can see the 50-day SMA crossing over the upside of the 200 SMA, referring to the fact that the stock is considered golden or nearly sure to rise in price once that happens. So here's your 50-day moving average crossing the 200. You can see that the price of the stock is rising. Now these, in conjunction with other short-term SMAs, like a lot of people use the 10 or the 9 in swing trades, and we'll look at that in some charts here in just a second. These are the basics of what we use when we're looking to determine when we get in or get out of a stock. So we're just going to do a basic chart. Here's the SPX, which is the S&P 500 index, and it's on the daily, and it goes back 3 months, and it shows the MACD along with the RSI. And we're going to go to a point right here where the MACD crosses the signal line for the positive sign. You can see that right here we closed up from the previous day, and we also see that the RSI is also moving up. As this gains strength and it separates itself a little from the signal line, it continues to go up in price and go up in price to this point right here. And then we go to the next day, and it's still, you can see the MACD is still parallel to a small bit up, but the RSI is starting to come down. So as a trader, you'd be watching that, and you can see the next day we had a lower close, and the MACD is also going parallel again to the next day. The RSI just went up slightly. The next day it went up a little more. Then we continue to see that the signal line's coming up closer to the MACD, and at this point right here, this is April 6th, the MACD was starting to cross the signal line, and we start to see the market go down. And then so we're having a rollover here in the MACD below the signal line, along with a rollover below the 50% on the RSI also. So I'd expect, this is April 11th closing prices here, that the strength tomorrow will be again weaker basically on this chart. So I wouldn't be a buyer here. You might actually be somebody who might want to short this. So let's go to Google And we'll go about the same area, right? About here, we see that the MACD is crossing over the signal line. This is March 16th. We also see that the histogram is showing more strength into a bull as it goes from negative to positive, and the RSI crossed over the 50% line. As we keep going, we can see it separating. The histogram is getting more and more bullish as we can see the MACD line is continually separate from the signal line. The RSI is continually moving up towards 65. We got to about this point, and you can see with Google that the MACD started flattening out. Even though down at the bottom we can see that we're starting to go up with the RSI a tad bit. And then we started to roll over closer and closer, and we look at the histograms are getting smaller and smaller, showing that we're getting closer and closer to the signal line. And at this point here, we cross the signal line, and you can start to see the prices going down for the last 4 days as we continually show strength. And you can see the histogram is getting bigger on the downside, on the negative side, on the bear side, and we're also losing strength in the RSI. So Google is right now, as this chart shows, is weakening and not going stronger. So I wouldn't be a buyer here for me personally based on this information. Let's look at Zim. Zim's been pretty popular lately among traders and investors. And we'll go back to about this point right here, and that will be March 9th. And you can see it March 9th, we had a crossover on the MACD line, on the signal line. And we also see that for the prior 2 days, we're seeing strength in the RSI. So as the RSI keeps coming up, you see the MACD starting to separate from the signal line. We also see that the histogram is getting taller, showing a more of a bullishness. And up here, the price continues to rise to this point here. Now the MACD slides parallel with the signal line. We're starting to see that the histogram is slowing and shrinking. And then at this point, we see that the RSI has collapsed down, and we have another crossover at this point. From here, the MACD continues down. The RSI trades sideways, which you're going to see that the stock also trades sideways. To this point here, we continue to go down in price. When you can see we continue to go down, and the MACD continues to separate from the signal line after the crossover. So again, I'd expect that we have some more downside based on this chart with Zim, and we are also at about at the 30, which is the oversold line for Zim. So just for fun, we put in the 50-day moving average and the 200-day moving average down here, just to show that at this point we were trading above the 50 and the 200-day average. When we got to this point, we started to trade under the 50-day moving average, and as of today, it looks like we're closed at or just below the 200-day moving average, which for me is a warning sign that the Zim could possibly go lower. If we can close down below that 200-day average, for me, that's going to be a trouble indicator on Zim. Now let's look at something that I would look at, and the way I look at getting into a security or doing a swing trade. This is Southern Company. It's a utility company. You can see we have, again, the MACD and the RSI. We have the 200-day moving average, and we have the 50-day moving average. I'm going to include another moving average, one that I can trade off of, and that's going to be the 9-day simple moving average. So this blue line is the 9-day simple moving average, and for me, I trade when the daily average closes above the 9-day moving average. That's when I'll get interested in trading. So in this point here, if I was watching, this is below the 9-day closing prices, and then it goes under the 200-day, which I don't trade under either. And then it popped back up, and at this point you can see that the 9-day crossed the 200-day moving average. And at this point right here would be a trigger for me. And if we go down, you can see that the MACD is rising and the RSI is rising, and I have a close above the 200-day moving average and the 9-day moving average. I'd continue to ride this trade as long as it stayed above and didn't close below the 9-day moving average, which it didn't. It still hasn't. Even though I got close, and then it broke out again and rated all the way up, and here's today, and it looks like it closed at 74.48, basically right above the 9-day moving average. So I'd be watching this, and tomorrow if it closed below, or I may have gotten out, seeing that there was a big drop, I may have gotten out of this trade right here. But we would have gone from, about $66 to about $74.50 on that trade if we got out right there. And that's how I would do it. You can see we're still above the 200-day moving average and the 50-day moving average. You could stay in this trade, and it could pop up and continue to go higher. You can see down here, though, that the MACD is rolling over and the RSI is rolling over. So that's because we have this nice candlestick to the downside. Probably an indicator that I probably would have gotten out of this trade myself. So now we're going to look at UNL, the United States Month Natural Gas Fund. So when the war in Ukraine started, and then we started seeing oil prices, wheat prices, commodity prices go up, and then we've all heard about, natural gas prices. I looked into this particular security to see where it was trading. You can see that it's trading above its 200. It's bouncing off the 50, and here's our 9-day moving average. So if you would have been in this trade, you would have looked here and about this point right here, pretty much gotten in here or here as you're above and you closed above the 9-day moving average. Now remember, commodities are very volatile, so this is not something you just put on and leave. You should watch it very closely. Down here you can see the MACD is just crossing over. We've got a fairly high in between RSI moving sideways. This trade continued to hug the signal line until just recently it started to separate from the signal line, but we stayed above. At this point here, you might have gotten out. You would have got back in here, and then you would still be riding this trade all the way up. If you got back in at this point, you would have been in around 15.85, and you'd be at 21.28 at this point. You see the MACD follows it, and the RSI is up at 81.70. So this shows we're in a overbought position, but it also shows the MACD still showing strength as we see in the price. So you don't have to be in the commodities to prosper on something like, rising prices because of some type of an event such as the war. Here's the Kellogg Corporation, which is really a pretty boring company when it comes to most people. They make cereal, okay? But if we looked at this and about the time we were seeing where wheat and corn prices were starting to come up due to the war, down here you'd see it would have crossed the 9-day moving average right here. Now, this would violate my rule. There's the 200-day that I would trade here, but had you traded over the 9, and you can come down and see that right here, the MACD crossed over the signal line, and we also started seeing strength in the RSI as the MACD continues to show strength and separates from the signal line. You can see it's getting stronger on the histogram, and now we're just basically riding it out. This stock has gone from about $61 to $67.80 over the course of these days right here. So even a boring stock, you can swing trade. And you've got to remember that over the last couple of weeks, we've had some really good down markets. And this stock here has been up every day since this point right here. Now, I'm more of a fundamental investor. I like to look in to the 10Qs and the 10Ks, get into the financial statements, see if there's any risks that I didn't know about that they're not telling me about in their marketing materials and their websites. But I do use fundamental and technical together. So when I do decide to buy a stock, I will go and look at the right price to buy it. I don't want to buy a stock when it's too high. So I want to go and use technical analysis in the MACD and the RSI to help me do that. Now, there is a certain percent, 10% or less, of my portfolio that I do swing trade, and I use the MACD and the RSI along with simple moving averages to help me determine when to get in and when to get out. Now, nothing is certain. Sometimes you make mistakes and you got to get out. But for the most part, the system seems to work for me. Now, for you, I want you to do your own due diligence, learn how to do this if you plan on doing a little bit of swing trading. But it can be profitable, it can be fun. You need to put the time in to do it to make sure that you get a quality output. So again, know what you own and why you own it. Don't trade on hope, because hope is not a strategy. We'll see you next time. Make sure you hit the like button. Make sure you hit the subscribe button. Have a good day.